Thank you for being here this morning. As you just saw the message, this is going to be recorded so that you can watch it later if you want to. And we are partnering with the Taunton Area Chamber this morning to do this workshop. It's the second time we've done it. We work very closely with the Taunton Chamber. My name is Jessica. I'm from Seed Corporation. Our offices are about a mile apart from each other. And the mission of both our organizations is just to assist business owners and prospective business owners in the different ways that we do. Seed provides financing and technical assistance to small businesses, and the Taunton Chamber acts as a representative body for the businesses in the area. And they do a fantastic job. So this morning, what we're going to be talking about is borrower basics. So if you are in business or if you're someone who works with business owners and you're assisting them on a daily basis, financing is one of those things that comes up quite a bit. So because it's not something that a lot of people have a ton of experience with, we do this workshop just as an introduction to what lenders look for when assessing a loan application. Just some housekeeping things. If you have any questions at any point during the presentation, please don't hesitate to ask. I much prefer when it's more conversational and you're asking the questions and the things that are on your mind. You can put the questions in the chat box, or if you prefer, you can raise your hand and I'll unmute you so you can ask your question. Okay. All right. So when we'll get right into it. When we're talking about lending and borrowing, there's a couple different options for you as a business owner. You can go traditional route. So that would be a bank or a credit union where you're going, you need funds for your business. So you say, I need $50,000 to start up my business or to grow my existing business. And the bank is going to assess that application. You can also look at SBA financing, which is what Seed does. Seed is an intermediary lender for the SBA. So the programs that we're primarily dealing with are SBA funded. When someone comes to us for a loan, we do want to see that you've been to the bank first, but we're going to assess it a little bit differently. We're really here to provide financing to those businesses that aren't able to get traditional financing at this point for whatever reason. So the slide that I have, our first slide is the 6 C's of credit. And this is essentially the rubric that most lenders will use when assessing whether or not they can provide financing to you and your business. It's a little bit different. Some people will look at the 5 C's of credit, but this is how we talk about borrower basics. So the first thing on the list is cash flow. And cash flow is how we as lenders assess if a borrower has the ability to repay a loan or any credit that we're going to extend them. When we're looking at cash flow at Seed Corporation, we're usually going to look for a 1-to-1 cash flow ratio. All that means is that for every dollar going out, we want to see at least $1 coming in, because that means you're breaking even. There's for the banks and credit unions, usually what they want to see is a 1 to 1.2, maybe 1 to 1.25 cash flow ratio. So for every dollar you're spending, they want to see you making $1.25 or $1.20. When we're looking at cash flow, we're going to look at a global cash flow. What that means is that we're going to assess the business financials, so the income statement for your business, the projections if you're a startup business, and we're also going to look at you personally, because we know very often with business owners, the money that you make in the business is going to help some of your household obligations, and likewise, especially when you start, you're going to be putting some of your personal funds into your business. So we'll also look at a debt to income ratio. When we look at debt to income, we are really just trying to figure out how much of your current, we'll call it a line of credit that you've extended. Meaning if your salary coming in is say 50,000, but your annual bills come to 40,000, well, that's tough because there's not a lot of wiggle room there. When we look at debt to income ratio, we are going to pull credit report, which we'll talk about in the next slide, and just kind of assess whether this is you're highly leveraged or whether there's room for additional debt in the business loan. For business financials, when we're assessing that cash flow, a lot of people will be, especially, our clients, they'll be in the startup phase. So in the startup phase, we do understand that you don't have historical financials to show us, and that's where those projections come in that I mentioned. We want to see a year 1 projection for all startup businesses that come to us. and interim financials for businesses that have been operating or have recently started operating. So the last year of, if someone came to us right now, we'd want to see 2023's interim financials. So the in-house prepared numbers that you have. If you started operating in September 2023, give us those 3 months, and then we'll see, we'll annualize it. We'll look at your plans for the next year, look at the growth plan. All that gets factored into it. When you're trying to assess your own cash flow, you don't have to be an accountant to do it. It's just adding and subtracting. But all you're really, again, all you're really looking at is how much do I have coming in, how much is going out, and how much room do I have to take on more debt. So in the 6 C's of credit, cash flow is the first C, credit is the second. And a lot of times when people think about lending, I think there's a misconception that credit is the thing that matters most. And while it is important, it's not the only piece of the puzzle. Of course, cash flow is how we determine, can you repay a loan? Credit is how we determine, have you paid your debts in the past? What's your borrower history? And a lot of times we will pull the credit for any guarantors. So that's the personal credit score of the business owner, as well as any spouse, partner, business partner, anyone who is guaranteeing the project. When we pull your personal credit score, we want to see scores of 600 or higher. And it's not necessarily a hard and fast rule. We're really more interested in the credit history, like I said, but 600, if it's higher than that, usually we can take a look. If we're doing a project unsecured, meaning no collateral, we'd like to see 680 or higher. And I'll get into that in the next slide because collateral will be our third C. But in talking about credit, when I'm looking at someone's credit report, it could be, say, a 620 score, but there's two ways it could go. Someone could have a lack of credit, which could cause a low credit score, or they could have a poor payment history. A lack of credit is certainly better than having a poor payment history because it just means that your credit history doesn't extend far enough back to really boost your score. Whereas in a poor payment history, we can see that you've had bills, you've had debts before, and maybe there have been late payments, or maybe they've gone to collection, or maybe you had an auto loan and the car was repossessed. There's a lot that can show up on a credit report. When we see those things, we'll always ask for an explanation because we do understand that life happens and there are certain things that can cause a lower credit score or a questionable looking credit report that don't necessarily mean you're a bad borrower. It could just mean that you had a life event that created an issue. These could be, it could be a divorce, it could be a medical situation. Maybe you were out of work for some time and that caused you to fall behind in your bills. Whatever it is, just be prepared to tell the lender that story and to just provide an explanation for why things happen the way they did. This is true for an SBA lender like Seed and for a commercial, for a credit union or a traditional bank. Usually the banks and credit unions will want to see a score of 680 or higher. If you're speaking with your lender, it's always a good idea to just tell them up front what you think your score is. And if you know that there's any derogatory items on that report, not only will it just kind of reflect well on you, just being open and honest and transparent about your credit history, but if a lender knows from the start that you are not going to qualify based on your credit score, then you can save yourself a lot of time and you can save yourself that credit pull, which oftentimes will be a hard inquiry and may lower the score an additional couple of points. The other thing that factors into our credit assessment of a prospective borrower is whether or not they've had a bankruptcy. Under SBA guidelines, if you've had a bankruptcy, it has to have been discharged for at least 5 or more years. And that is generally a hard and fast rule. So if you know you've had a bankruptcy in the past, again, be as upfront as you can about that. If one of your business partners had a bankruptcy, if you have a spouse who's guaranteeing the project and they had a bankruptcy, that's just something that we want to know because we don't want to take you through the process of an application and ask you to give us all of these documents and things if we know ultimately it's not going to result in approval based on something that we knew at the beginning. And I always like to say, it's when we're working with our borrowers and our applicants, it is pretty common that people have had credit issues in the past. And while there are lots of businesses and resources that you can pay to help repair your credit, we always kind of steer clear of those. First and foremost, you don't know if you're paying someone, they're actually going to assist you in repairing the credit. But secondly, and more importantly, there is a free and confidential resource pretty local to us that works with helping people repair their credit. And I think that this is something I can send to everybody after today's session, but it's called the American Credit Counseling Service, and they are located in Plainville. They offer, like I said, free and confidential credit mentorship, and they're a nonprofit, so they'll never charge you anything. They won't sell your information at any point. It's a really fantastic resource, and I refer to them quite a bit just because they are very good at what they do. Okay. So I'm just going to, I'll just check the chat, no questions yet. So we'll move on to our third C. When we're talking about the 6 C's of credit, collateral comes in at number 3. Collateral is how we secure loans. So when we're extending financing to a business owner and their credit looks good and cash flow is where we want to see it, there is still the unknown where something could happen that causes someone to be unable to pay off their loan. And it could be a lot of different things. The business could go under, unfortunately, that does happen. The person who we provided the loan to could pass away. That has certainly happened in the past. And at that point, to secure the debt and to make sure that we get those funds back so that we can lend them to the next business, we look for ways to secure the loan that we're providing. So the main way that we do that is by taking a position on a commercial or personal property. We prefer to do a residential property because it's a little bit easier, less expensive on the borrower's end. But basically, we would take a position behind any existing mortgages or lines of credit, and that would be our security. Meaning, if at any point the loan was not being paid or if the borrower stopped contacting us, we would look to get payment from the equity in the home. We also do take positions on business assets or equipment. Again, we do prefer the property because in a liquidation situation, which no one wants to think about, but can happen, the equipment, while very important to your business and valuable to your business, doesn't hold much of a value to a lender, or in an SBA case to the U.S. government. So the real estate does hold its value. Properties often will appreciate, whereas business assets will usually depreciate. So that's why we always ask if you own a home and if there is equity in the home for us to use as the collateral. If someone does not have collateral, meaning if they do not own a home, if they do own a home, but maybe they've just recently purchased the home, so there's not enough equity to cover what they're asking for, there are several other options. We can look at a guarantor, which I've mentioned a couple times, but this is basically just someone who steps in to provide the collateral that is lacking from the application. So that could be a family member who does own a home, who's comfortable using it in the loan. It could be a spouse or partner, business partner, just anyone who has an asset to provide that makes us feel like the deal is overall a little bit less risky. We can also look at providing unsecured loans up to $15,000 with 680 or more credit score. So that would be completely unsecured. We would probably still look to take a UCC on the business assets, but we would not need a home or a commercial property in that instance. And then if you're looking for something, if 15,000 really isn't going to get you where you need to be, and you need something that's say 50,000 or more, there is also the SBA 7A guarantee. Sometimes you may have heard it referred to as the Community Advantage Loan. Under that program, the SBA essentially acts as your guarantor. They guarantee 85% of the project, and they're kind of like your co-signer. So for larger projects, that is an option. These are projects where oftentimes the credit has to be pretty strong. The cash flow should be strong as well. But if we can make it work, we do like to use this program because it does provide, it gives us the ability to provide financing where people need it without having to use a home. Okay, so I do have a question. Um, Cassidy is asking, is there a good way to shop or compare different creditors without running your credit multiple times? Of course. Um, I I always say that your first stop should be the bank, and it's best to just have the conversation with the lender that you're working with. The, it's not the same as shopping around for, say, a car loan, where you just kind of go and they tell you what they can provide, what rate they can give you. At Seed Corporation, for small loans and micro loans, we have a fixed rate and pretty much fixed terms, although they are flexible. And that's what we use. So we can tell you the rate and the term pretty much in that first conversation. And we can also tell you the guidelines that we're going to look at, and we can talk about your situation personally. The banks can do the same thing. They can tell you upfront before running your credit whether or not they feel like the application is viable. If they feel like it's not viable, they're not going to waste your time or pull your credit unnecessarily. So you definitely should talk with different lenders, whether that's the bank that you do your personal banking with or um, lenders like Seed, and just compare the not only the rates and terms, but also what the feedback was in terms of how likely are you to get this loan based on your personal information. That's a good question. So the next C in the 6 C's of credit is contribution. Contribution refers to what you as a borrower can inject into the financing project. Normally, a lender is not going to provide 100% of the financing necessary to start up a business or to finance a new project for an existing business. For startup businesses, we want to see that you have the ability to contribute around 25% of what you're requesting. So if you were looking at, we'll keep the numbers really easy. If you were looking for a $10,000 startup loan for working capital, let's say, we want to see that you have already contributed or have the ability to contribute 2,500. That could be money spent on legal counsel. It could be marketing material. It could be money that you have just in reserve to contribute as the business gets going. Maybe you have a rainy day fund that you yourself have funded. You put $3,000 in it, and that's for repairs and maintenance as they come up, whatever it may be. I always tell, especially the startup clients, I always tell them to just keep track of everything that you're spending on the business, even if it was a year ago, if it was shopping around for getting different, let's say, marketing prototypes, shopping around for software for the bookkeeping that you're going to do on your computer, getting laptops, whatever it may be. Keep track of all of that because we want to give you credit whenever possible. For existing businesses, it's a little bit different. We can look at the assets that you have in the business, as well as the money that you've invested to date into the business. If someone has been around for, say, between 5 and 10 years in business, we can pretty safely assume that they have put their personal funds into it at some point. It's just the way it goes. And the contribution is going to vary based on the loan program, based on the industry, and the lender that you're working with. So always just ask about this up front and let the lender know what assets you have to contribute. So the next C, while it does not heavily relate to the numbers like we've been talking about with cash flow and credit, collateral, contribution, this is hugely important. And I think when we do this workshop with our banking partners, there isn't a single lender that I've ever worked with that says character isn't important. It's really important. And it refers to, it goes back to the will you pay question, but it really refers to you as the business owner. Are you the right person to run this business? Do you have the relevant education or certifications? Do you have experience in the industry that you're going into? So personally, I love to bake, but I don't think I could open a bakery because I haven't worked in a bakery, and there's a lot more than just making cookies and muffins that goes into that. Um, so what type of experience do you have, and how is that going to help you run this business or grow your existing business? What's your personal financial history? All of this goes into the character piece. Another big part of the character piece, though, is how are you to work with when we're going through the lending process? If I'm working with somebody and they are really transparent and forthcoming, they tell me about things I'm going to find before I find them in the credit report or the tax returns or the personal financial statement, then that that honesty goes a long way. Because when we're looking at a loan application, we're not just assessing, can we make this loan right now? We're also trying to assess what is this lending relationship going to look like when we're 2 years into the term of the loan, 3 years, 4 years. For a lot of our loans, they're 7-year terms. For the smaller micro loans, they're 7-year terms. So are we going to feel comfortable working with this person, getting payments for the next up to 7 years? A lot of that can be gleaned in the weeks that we spend trying to push that loan through to an approval and to a closing. And we'll also, of course, look at previous business performance. So if you've owned a business in the past, how did that go? What are your strengths and weaknesses as a business manager? And if you know that you're lacking in some areas, who do you have in your team to kind of help that? A good example is people who want to start up a restaurant. Someone may want to start up a restaurant because they're a very talented chef or they've worked in restaurants before as servers, but maybe they've never ordered for a restaurant, or maybe they've never actually worked the scheduling plan for the employees. Are you going to be able to bring somebody in who has that necessary experience, who can be that person for you? And I'll say one more thing about character, just because I really want to drive home how important it is. There are absolutely cases, and all the lenders that we've worked with will say the same thing. There are cases where somebody is maybe just teetering on the line of being bankable and not. So that means they're just about where they need to be to get the loan or to unfortunately have a decline. And sometimes the character piece is the make or break. If someone is just on that line and they've been really questionable to work with, meaning they haven't been straightforward about things. We found out about things that previously they said, weren't an issue, and maybe there was some dishonesty there. That would be a reason to say, it's just not a strong enough application. Whereas if somebody is kind of financially just about making it and they have really good experience, or they've been incredibly transparent and they've been proactive in getting you the things that they need and really preparing, spending a lot of time on the application, the business plan, and all that, that can work very heavily in their favor. So it can't be understated how important character is in the 6Cs. And then the last C is one that we actually added ourselves. It used to be the 5Cs of credit, but we include this one now. Condition refers to the condition of the economy at the time the loan request is being made. So that is probably most easily illustrated if you rewind 3 or 4 years ago when COVID was more of an issue for business owners than it is now. How do certain businesses perform in different economies? At the time, we were really having to ask, how are you going to combat the occupancy rules if you have a brick and mortar location? If you're selling online, are you going to struggle with supply chain issues? If you're a service-based business, are you going to be able to safely administer your services and make your customers and clients feel like there isn't a risk for them getting sick for having worked with you? Those are things that we want people to just be aware of. And also just, in general, just to keep your finger on the pulse of the economic trends and how your industry performs in different economies. There are some industries that will do very well in a down economy. Our industry being one of them. When we're in a down economy, we tend to see that for our workshops, at the very least, we have a lot more seats filled. And when the economy is good, maybe people are looking less towards starting their own business or, taking these classes because things are okay. There are industries that will not do well in a good economy and ones that won't do well in a bad economy. It's just, we kind of leave it up to you, the business owner, to do that research and to let us know, to just pitch that to us. If things are going a certain direction, how are you going to deal with that? And why is your business going to survive economic fluctuations? So those are the 6Cs of credit. And I know it's a lot of information. We don't ever expect anyone to memorize everything. Like I said, you don't have to be an accountant. You don't have to work all of this out on your own. If you're thinking that it's time for your business to get a business loan and you need some financing, just pick up the phone and call your lender. They will be able to talk to you about all of these things as they pertain to you. So they'll talk to you about the credit guidelines, then they can talk to you about your credit. They'll let you know, what they need to see in the cash flow. You'll provide it to them based on what you have available. So It's an information heavy section, but it's always easier, I say, just contact your bank, your credit union, Seed Corporation, the Taunton Chamber. We're all very well connected. We all work very closely together. So regardless of what your question is, someone will be able to assist you and just talk you through this process if it's feeling overwhelming and daunting. So we'll switch gears. That is everything that kind of goes into our financial analysis of a loan application when we get one in. But we're also going to want to see a business plan. It is absolutely required for startup businesses, but even existing businesses, if you have a business plan, that is really helpful to us, especially if we can push that loan through to underwriting. It gives us a lot of really great information. So what should the business plan include? It should include a statement of purpose or a mission statement, and I'll explain the difference between the two. A table of contents, of course, just to keep things organized. A description of your business I'll touch on the main things that we want to see in that. A marketing plan, and of course, your financial information. And when we won't go to that slide yet. When we talk about statement of purpose or mission statement, there you'll have one or the other. If you have a business plan, you can be using it as an operating guide, or you can be using it in your financial proposal. If you are using it as an operating guide, then a mission statement is sufficient. So who you are, what you do, why you do it, and basically what is the purpose of the business. Maybe the purpose is to provide great landscaping services to residential and commercial clients in the Tri-County area. That's your mission statement. Very simple. Statement of purpose is a little bit different. Statement of purpose will be used if you're treating the business plan as a part of a loan application. So in your financial proposal, we'll want to know immediately how much you're looking for in financing, what are the use of funds, and where are those funds coming from. I have a slide later on about sources and uses of funds, so we'll hold off on that. But that's the difference between statement of purpose and mission statement. For your business description, and this is also required for existing businesses, we'll need to know the type of business you operate or the industry that you're in. It could be multiple industries, and that's fine. If you have a service-based industry, but you also have a retail side, just let us know that. The status of the business, so is it a startup or existing? This is tricky because this could change depending on who you ask. When we're looking at loan applications as an SBA lender, we consider anyone who is at or past that first year of operations to be an existing business. It's a little bit different when you go to a bank or a credit union. Normally, a traditional lender will want to see that you have 2 to 3 years of tax returns before considering you an existing business. And that's not to say that you can't get startup financing if you go to your bank or credit union. There are banks that will lend to startup businesses, especially if they're existing clients. But it just means knowing that ahead of time is helpful, because if a bank tells you right away that they're not able to lend to startup businesses and you've been in business 18 months or 2 years and you don't have your second year of tax returns yet, then you know that it's not going to be worth your time to submit an application to that institution. The form of the business we'll need to know: are you a sole proprietorship? Are you an LLC, an S corporation? C corporations we don't see too much. And what's your plan? Are you planning to stick with the legal organization that you've chosen? Or are you going to go from a sole prop to a corporation? Or are you going to go from your LLC to a sole prop? Just let us know what is on the horizon for the business. Location and hours of operation, that's important, of course. Your market description. So in your market description, we want to just have you tell us a bit more about your target market. Who do you sell to? Where are they? If you're a startup business, this is incredibly important to know ahead of time, and something that a lot of people find very difficult. It's an important piece because you don't know how to market your material, your products or your goods or services, or what the marketing messages should look like until you know who they're meant to attract. So establishing your target market is very important, and that's something that we'll want to see in the business plan. Description of competition is probably just as important as your market description. When we're talking about your description of the competition that you have, we will break it up into two main categories. We'll have your direct competitors. A direct competitor is someone who is doing the exact same thing you're doing. So they offer the same product, the same service. That's it. An indirect competitor is someone who offers an alternative to your product or service. So a good way to think of it is for a direct competitor, think of Coke versus Pepsi. That's the same drink. It's just being made by two different companies. I'm sure many people would disagree, but for the purposes of this explanation, that Pepsi and Coke, those are direct competitors. Indirect competitors would be, say, Coke versus Gatorade, or Coke versus drinks that are maybe a little bit less sugary and syrupy, maybe marketed to be healthier than soda. That is an alternative to Coke. So they're an indirect competitor. And then last but not least in the business description, you want to have an organized description of your management and personnel team. If that is just you to start, that's okay. The management and personnel section just helps us have an idea of how many people are required to operate your business. And also, if you have the ability in the next couple of years after getting the loan, if you have the ability to create new jobs, which is, of course, what we want to see. A big part of our lending mission is to strengthen the local economy, the regional local economy, by providing financing that allows businesses to grow, put that money back into the economy, and also to create jobs in the area. So I mentioned we're going to get into the sources and uses of funds. So we have it on a separate slide because it's something that a lot of people maybe find difficult when they first go for financing. One of the first questions that the lender you're working with will ask you is, how much do you need? And very often when I ask this question, I hear in response, as much as you can give me, which is not the answer that we want to hear as lenders, but I do understand the misconception. It's a business loan is so different than the other loans that people will have usually gotten when it's time to go for a business loan. When you're looking for a car, you want to see, what kind of car can I afford to drive? When you're looking at buying homes, what type of home can I afford to live in? Those are relevant questions for those types of purchases. For a business loan, it's less about what can I afford and what do I have the capacity to repay. And it's more about what amount of money is going to be most beneficial to me growing my business and to my business succeeding. So that means that if your business, let's say to operate your business effectively and to reach your profit goals, you need 3 pieces of equipment and they each cost $10,000. And with those 3 pieces of equipment, you will turn out your products at a rate that is most cost effective for you. If you need 3 pieces of equipment at $10,000 each, then your business needs $30,000. But let's say you really can only afford to repay a $10,000 loan. You would have to ask yourself, is that $10,000 going to get me where I need to be? Am I going to be making money or losing money if I'm only producing a third of the product that I said I would produce and sell? So we don't want to make a loan that's lower if it's not going to help somebody actually be successful or turn a profit. On the other end of things, if your business needs $30,000 and you can technically afford to repay a $50,000 loan, it's not a great idea to just be borrowing that extra debt because it's just going to tighten the cash flow. And maybe the money that you're repaying to the lender could be used in other areas of the business. Maybe it could be put back into the business. Maybe it can help you pay your employees or yourself a better salary. So getting the right amount, or at least getting a range where you're comfortable, is very important. So the lender will ask you, how much financing do you need? And you'll provide them that number or maybe just a range. We'll also be asking, how much do you have to inject into this project? Now, we went over it a little bit ahead of time, but this is just the sources of funds. Maybe seed is, you're asking seed to provide 80,000. Maybe you are going to provide 20,000. Maybe your business partner who has, say, 5% interest in the business is going to be gifting the business funds. We just want to know where all the money is coming from and how it's going to be paid back. If there is money that's being given and it truly is just a gift, we'll request a gift letter so we know not to put that as debt in the cash flow. And we do ask that people include estimates or quotes whenever possible. If you're asking for funds to do leasehold improvements, being able to supply us quotes from contractors or just printouts of things that need to be purchased for the space is helpful for us to justify why we're giving you the amount of money that we're giving. We'll also want to know if you have been to other lending institutions and if you've requested financing from them, what was the result? If you were declined by anyone prior to coming to Seed, we'll just want to know what the feedback was. Why were you declined? Oftentimes, if we're looking at requests, say above 20,000, we do like to see that you have a bank decline letter or some correspondence from the bank that just states that they were not able to provide financing. We don't want to take any business away from the banks. We want that to be your first stop. The banks oftentimes can offer things that Seed and SBA lenders can't, like lines of credit or business accounts. So it is in your best interest to make that the first person you talk to, and then see what options are available to you if banking, traditional banking is not going to work. A lot of our clients come to us from bank referrals. So it does not work against you to have gone to a bank first and have been declined and then come to Seed. Quite the opposite. A lot of times we do require it. Oops. So the financial information part of the business plan is really important, and it will take up, I would say, probably the bulk of the plan. There are a few things that we want to see from everyone, whether it's existing or startup. We want to see a personal financial statement for the business owners, anyone 20% or more, or any other guarantors. We want to see the personal financial statement. So what that is basically it shows us your net worth as an individual, or for spouses as a couple, because we'll have you fill out jointly if you're applying with your spouse. And it shows us all the assets that you have alongside all the liabilities. Your assets are your savings accounts, your checking accounts, cash on hand, the real estate that you own, what is the market value of that? The vehicles that you own, what's the Kelley Blue Book value? And then personal property. So furniture, electronics, jewelry that holds value, all of that will be put together to create a picture of your assets. And then your liabilities. Your liabilities are your debts, whether that's credit card debt, installment debt, which could be car loan, student loan, your mortgage balance. If you own a home, we're going to count the market value, but on the other side, we want to know what you owe on that home so we can get a true picture of what it's worth to you. And then any unpaid taxes, anything like that. And it's really important to disclose all of that to us. The personal net worth of somebody is not going to factor heavily into our decision, but it helps us to know what's going on the personal side so that there just aren't any surprises or anything that would maybe hurt the application that we need to be aware of. In addition to providing the personal financial statement, existing businesses should be providing us a year-to-date balance sheet or just the most recent balance sheet that they have. A balance sheet for a business is exactly what a personal financial statement is to an individual. So the balance sheet will show all the business assets alongside all the business liabilities. Business assets could be furniture, fixtures, equipment. It could be money, just cash the business has. It could be a lot of things. And on the other side, liabilities, very similar to the personal liabilities, are the money that the business owes, whether it's to creditors or to businesses or companies that they've purchased equipment from. Basically, it's just the debts. If you are applying for a loan with a traditional lender or with Seed Corporation and you need assistance with the balance sheet, we have lots of fantastic resources that can help. I'll go into those a little bit later, but it's always better to have a second set of eyes look at that information before we take a look, because it can bring up a lot of questions if things aren't matching up. And then alongside the balance sheet, we also want to see the income statement for the business. The income statement, so at this point in time, if you were to apply with Seed Corporation today, the income statement would be the interim financials for 2023. So January 1st, 2023 to December 31st. That's what we would ask for. If we're further along in the year, the income statement is usually just a year-to-date track of the financials, because ideally we'll have your business tax returns from the last business year, and the income statement will just show us the trajectory and how things are going. When you're preparing your income statement, there's, again, if you need a second set of eyes, there are resources that can help you. We don't want to see an income statement that looks incomplete, and we certainly don't want to see one where the numbers aren't matching up, or there's anything else that's, questionable. Maybe last year the business profits were 50,000, and this year in the first 6 months of operation you're showing 200,000 in profits. That would maybe raise some questions for us. So the balance sheet and the income statement year to date are required for the existing businesses. We will also ask our existing business owners to provide 2 years of full federal tax returns, or just the federal tax returns that they have available. So if your business is currently in its second year, just show us the first year. And if in the first year, maybe you didn't operate the full year, or maybe there's a certain seasonality to your business that you didn't really hit because you missed the season, that's fine. Just providing that explanation is helpful. And then last, we'll want to see a list of business obligations, which is just an itemized list, as it sounds, of the debts that the business has. We'll ask for the creditors, the balance, the income, the interest rate, and the monthly payment, because all of that will be factored into our cash flow. The list of obligations is helpful not only so that we can we can allow for that debt, but sometimes we see really high interest business credit card debt that we can actually refinance at a lower rate and maybe help the cash flow breathe a little bit more. So you always want to be as open and honest for the list of business obligations as possible. If we see anything that we think we can alleviate, we will try to do that. And then for startup businesses, we understand that you obviously won't have an income statement because you will not have started selling yet. Or maybe you've only been operating for 3 or 4 months and there's no history beyond that. We'll ask for a projected income statement. The projected income statement just shows what you feel you'll do in sales and ultimately in profits for the coming year. It's again, something that a lot of people do have trouble with. So if you are having a difficult time preparing that, please don't hesitate to just reach out and ask. There are mentors completely free and confidential to use that we can connect you with, who can really walk you through this and help you. Same goes for the balance sheet. For a startup business, we want to see a day one balance sheet, which means the day that you open, the day you open your doors, the day you launch your website, whatever it is, what is the business asset and liability look like on that day? And then for startups, last is the 12-month cash flow projection. A 12-month cash flow projection, very similar to the income statement. The numbers at the end will look the same, but it just breaks the income statement down month by month by month. So something to avoid is, let's say you've done your projected income statement and you want to, you have to do the 12-month cash flow. The 12-month cash flow projection should not simply be your projected income statement divided by 12. It shouldn't be that every month is going to show the same sales, the same expenses, the same profits. Like I said, there's seasonality. Most businesses, especially for where we are in New England, most businesses will have some seasonality to them. So you want to allow for that in your projections. Maybe summer is really the busy time for you. It makes sense that sales will grow and then peak in the summer and then maybe fall down a bit in the fall and winter season. Maybe just based on the industry that you have, it's going to take you a while to drum up business. If you're a service-based client and you're going to be relying on word of mouth, if you have limited funds to market in the beginning, it would make sense that, the first month of your projected cash flow, there's only a little bit in sales, but maybe after 3 months, 6 months, 9 months, maybe it's growing on a monthly basis. And these are just some final reminders for completing the loan application. I've said it a few times, but we repeat it so often because it is so important. The more the lender you're working with knows about you and your business, the better they can advocate for you and the business. A lot of times the lender that is crunching the numbers and your go-between is not the one who has the final decision on whether or not the loan gets approved. We have to put the package together and then submit it to whoever it may be. For us, it's our loan review committee or our in-house team that signs off on the loan packages. And if we're feeling like there's information we don't have, it's difficult to confidently advocate for that business getting that amount of money. Be neat and concise when you can in your loan application. It should be a professional looking package. It should be neat and organized. It's difficult, and for us on our side, it's difficult to get through an application that isn't organized. It takes a lot longer to get things. There's a lot more back and forth, a lot of questions. Whereas if everything's laid out neatly and nicely for us, we can get through it a lot more quickly. And again, just be honest. If you know that there are things that may disqualify you from financing, saying that as early as possible is the best practice. Just because a lender can't provide financing right now doesn't mean it's a forever decline. They might be able to tell you what you need to do and the steps you need to take to come back in 6 months, a year from now, and be a really strong candidate for a loan. So do just be forthcoming with that information and let the lender and the people that you're working with help you in whatever way they can. And that's what I have. So I know that is a lot of information. We left about 10 minutes for questions. If anybody does have any questions, I'm happy to revisit any of the slides, especially the ones at the beginning, since I know it was a lot. And if there are not any questions, like I said, when we started, this is going to be recorded. So you'll have access to this, Lisa, I think through the Taunton Area Chamber's website. And we'll also be sending the PowerPoint to those of you who attended. So like I said several times, if you do want to follow up, it's always easiest just to pick up the phone and call. My contact information is here if anybody does have any questions about SEEDS programs or just general borrower basics. But if there aren't any questions, then we'll end it a little bit early and we'll follow up with the email later this afternoon. If let me just check the chat. You're welcome. Okay. Everyone enjoy the rest of your day, and thank you for joining us. You can look for my email and Lisa's email with the material from today, and then follow up if you want to. Thank you very much.